It's easy to think rent goes up because of supply and demand. Too many people chasing too few homes. But the reality is far more complex. Even when new supply arrives, rents keep climbing. Even when inflation slows, rents keep going up. In part one, we explored how Canada's housing crisis squeezes renters through unaffordable home ownership and shrinking rental availability. But now, in part two, we're diving into the system itself, how it's designed to keep rents high, how policies often sound progressive but fail to help renters, how corporate landlords profit and government reforms barely scratch the surface. This isn't conspiracy, it's a business model and financialized market built to extract the most money possible from tenants. Let's start with Toronto. In early 2025, Toronto finally legalized sixplexes citywide, a big change, but one that has come with strings attached. Why now? The federal government has made clear if cities wanted infrastructure funding, billions of dollars, they had to commit to increasing housing supply. This means pushing low-rise densification policies, including sixplex zoning reforms across major metropolitans. Toronto's move was part of this federally driven push. The city has faced deadlines to either adopt these policies, which they did this week, or risk losing funding critical to transit and housing projects. So yes, the sixplex zoning reform was federal pressure in action. It was a condition attached to billions in funding, forcing the municipalities to act. But here's the problem. The reform came without any affordability requirements. Developers can build sixplexes and rent them at full market prices, which in Toronto means expensive. The average one-bedroom rent in Toronto now exceeds $2,600 per month. That's far beyond what most renters can afford, without any price controls or rent caps. These new units become investment vehicles for wealthy owners, not homes for working people. Urban planning experts, including former Toronto Chief Planner Jennifer Keesmaat, have said it bluntly. Density without affordability is just more expensive investment property. Municipalities are ticking boxes, but tenants still pay the price. Across Canada, financialized landlords, REITs, pension funds, and corporate asset managers have taken control of much of the rental market. In Edmonton, nearly half of the rental stock is owned by these entities. In Toronto and Vancouver, it's over 30%. Nationally, estimates suggest roughly 25% of all rental units are controlled by financial institutions. That means your rent is decided not by your landlord as a person, but by a boardroom focused on returns and yield. Take Cap REIT, for example, one of Canada's biggest REITs. As of early 2025, Cap REIT owns over 65,000 rental units across the country. Their investor reports don't talk about making housing affordable or stable. They talk about monthly rent growth, vacancy rates, and maximizing yield. And how do they do that? They rely on tenant turnover. Because in most provinces, rent controls only apply during tenancy. When a tenant leaves, the landlord can reset the rent to market rates. So corporate landlords have incentives to encourage turnover through above guideline rent increases, deferred repairs, or even tenant buyouts so they can raise rents for new tenants. This isn't incidental. It's part of a business model shared across financialized landlords. It's also the model promoted in real estate wealth seminars aimed at individual investors, teaching them how to replicate corporate strategies on a smaller scale. So the pipeline from small amateur landlord to corporate landlord is alive and well, scaling the system further. Let's break down how rent control really works, or rather doesn't, in most places. In Ontario, for example, the annual rent increase is capped at 2.5% for 2025, but only for units built before November 15th, 2018, and only for tenants who remain in place. If your building is newer or you move out, the landlord can charge whatever the market will bear. Landlords can also apply for above guideline rent increases for renovations or increased property taxes. Many get approvals for 5 to 7% hikes, sometimes even more. These loopholes create what's called renovictions. Landlords evict tenants under the pretense of repairs, then rent the unit at much higher prices. To make matters worse, tenants have little recourse. The Landlord-Tenant Board in Ontario is backlogged with complaints and disputes. This creates a rental market where long-term tenants are tolerated, but turnover is financially incentivized, maximizing rent over time. So what about federal solutions? Bill C-56 passed in 2024. It removes the GST on new rental construction, supposedly encouraging more housing supply. But in reality, C-56 offers tax breaks to developers without requiring affordable rents or tenant protections. The Canadian Bar Association and tenant advocates have criticized the bill for focusing on the supply side tax incentives, ignoring the demand side, renters themselves. Finance Canada's own projections don't guarantee that tax breaks translate into lower rents or better stability. So Bill C-56 may increase housing stock, but it does nothing to protect renters from rising costs or evictions. The rental market isn't broken. It's functioning exactly as designed. Profits flow to REITs and developers. Politicians claim victories with supply announcements, and renters keep paying more every month. In Part 3, we'll look at what that means long-term. The rise of permanent renters, the myth of renting as failure, and how Mark Carney's housing platform fits into this new reality. Because if owning is becoming impossible for most, renting at least should be fair and sustainable. Have a wonderful weekend.